Welcome friends to this new video of Sapphire Talks English. In this video we shall discuss the March 2026 Economic Review Report released by the Ministry of Finance, Government of India. In this report the ministry says that there is a complex and multi-layered risk situation for growth, inflation and external balances within India. Now this will definitely seem like a lot of jargon for many people, so let's try to analyze what exactly our government is trying to tell us. What the government is essentially saying is that because of the crude oil shock, there is an upward pressure on inflation in India as of just now. There's a downward pressure on growth, which means that growth seems to be reducing, and then there's definitely the situation of external payments, that is the amount of money that the Indian government and various Indian businesses and people have to pay to lenders from outside India. Now all these situations are getting aggravated because of the oil shock. Friends, all of us would be aware that once the price of oil increases, everything across the board becomes pricier. It not only increases the amounts that we have to pay at the petrol pump, but it also increases everyday used items like vegetables, fruits, medicines, etc. simply because of the higher logistic cost and because of the cascading effect that increase in oil prices typically has on any economy. There is definitely also the risk of current account deficit increasing. All of us are aware that India imports more than it exports, and this deficit is largely on account of petrol and petroleum products. Now, what is happening is that since the prices of crude oil are increasing and we are no longer getting any discounted or really discounted oil from Russia or from any other sources, what is happening is that the difference between our imports and exports, which was already in the negative, that is imports being more than exports, is increasing even further because of the crude oil shocks. The result is that there is a upward, or rather I should say a downward pressure on the rupee, that is the rupee is getting devalued, and Indian businesses have to pay those many more rupees for repaying a single dollar of loan that they have taken from abroad. The third thing is that there is uncertainty of growth. Till February 2026, the growth data is looking okay. It is very likely that we'll finish March 2026 with a growth of 7% to 7.5%. But the problem will begin for the fiscal year 26-27, when it is projected that because of all this uncertainty in the market and in all economies around the world, the original growth forecast for 26-27, which was again at 7.5% approximately, will have to be pared down to 6.1 to 6.5% because of the uncertain situation that India is facing for reasons beyond its control. So far, we can definitely say that the government of India has managed the crude oil situation in India quite well. We have not seen any increase in fuel prices at the petrol pumps. In fact, on account of the increase in fuel prices, when the petroleum distribution and refining companies wanted to increase their prices back to back, the government went ahead and reduced the excise duty on fuel by rupees 10 per litre. This way the government has made sure that the common public, that is the general public, has been insulated from the shock of price increases by refineries and distribution companies. But the situation definitely is not so good in the rest of our neighborhood. Now, for example, if we take Sri Lanka and Bangladesh, India has been helping them a lot with their requirement for petroleum products. Just yesterday, the president of Sri Lanka very openly thanked the government of India for all the support provided in this situation of need. In Thailand as well as in the Philippines, the governments there have introduced quantitative restrictions on the amount of fuel that can be distributed to the general public. So compared to all these countries, definitely it is very important for us to admit that the fuel situation in India is quite good. The government has maintained a lot of fuel stability in India, especially for petrol and diesel, thereby ensuring that there is no runaway inflation till date. Now, how the situation develops going ahead is something we'll have to wait and watch. In one of my earlier videos, I had indicated that since the war started on 20th February, right up to 23rd March, foreign institutional investors had pulled out approximately $8 billion from India. Now, friends, this is bad news for India, but this is something all of us should expect. People keep money in emerging markets like India because there is comparatively high risk, but there are even higher returns. Now, in complex situations like the present Middle East situation, people would like to move their money away from India and move them to safe havens like gold and commodities. So this is something that has to be expected, and if this war and uncertainty continues, more and more foreign institutional investors and foreign investors will be tempted to move their money away from the Indian market. Now the question here is, how do small investors, medium investors and small and medium businesses in India take care of the situation? My suggestion here would be, friends, first and foremost, you have to keep adequate cash flows in your hand. Do not make imports unnecessarily, because while repaying for those imports, it is going to be extremely expensive if the rupee depreciates further. Do not take external commercial borrowings or any borrowings from out of India, because the rate of interest may appear low, but when you have to repay those borrowings, and if the rupee continues its present downward trajectory, you will have to shell out that much more amount of rupees just to return $1. So my suggestion would be to be very tight-fisted, keep a lot of control on your imports and on your external borrowings, keep adequate cash flows to tide over this situation, and keep monitoring three things very closely. First and foremost, the movement of oil. If oil goes up, it simply means that rupee is going to slide even further. Second is the behavior of large central banks like the US Federal Reserve and European Central Bank. If these central banks increase their interest rates to control inflation in their own countries, it simply means that investors who are there in India just now will get better interest rates outside India. So they will further move money from India to outside India, and that will again put a downward pressure on the rupee, and rupee will depreciate further. And the third factor to monitor is the movement of the rupee itself. If we are seeing a downward movement in the rupee, like I said, we should control our imports and external borrowings extremely tightly, and we should try to export as much as we can, so that our margins are getting better and better. Friends, I hope that you found this video interesting. I hope you found my suggestions interesting. If you have liked this video, please go to our channel and subscribe to our channel. Put a thumbs up in front of our video. If there's any important development on this matter, I'll definitely make a new video and come back to you. Till then, I bid you goodbye. Thank you very much. Jai Hind, Jai Bharat, Vande Mataram.